Good morning from our global headquarters. I'm Manish Krani in New York. You're welcome to Bloomberg Brief. Let's set your agenda. Labour strength, Treasury slide as investors weigh the latest jobs data showing jobless claims, and services PMI on deck today. Middle East on edge. Oil climbs after a third day as Israel strikes Beirut. President Biden urges proportionality from Israel. And AI wins. NVIDIA's Jensen Huang says Blackwell chips are well on track. OpenAI raises funds to the value of $157 billion is the valuation on OpenAI. A very good morning to you. We have some restraint in these markets, in the equity markets this morning. To what extent did the ADP number popping at 143,000 indeed deliver a little bit of a flesh wound to the 50 basis point cut? NVIDIA is up 0.6%. The demand for Blackwell is insane. So stocks in the first instance just on the back foot. Yields popped, stocks dropped. We definitely are on conflict watch in the Middle East. To the bond market, let's roll it over, have a look at that. Of course, the bond gains have been unraveling, as I say. The narrative around a 50 basis point cut was just slightly, ever so slightly undone yesterday on the ADP numbers. We count down to the jobs numbers tomorrow and the jobless claims today. By the way, Royal London Asset Management's Trevor Greetham warns of a bloodbath next year in the bond market. So that is certainly something to consider. A little bit of breaking news for you on the PPI in Europe, in the Eurozone, comes in, it falls to 2.3% year on year. The estimate was for 2.3%. That is the year on year number. Let me just give you the actual month on month pips a little bit higher to 0.6% from an estimate of 0.5%. So those are the very initial take on the euro dollar there. As you can see, fairly flat at the moment. The CPI was the real needle moving agenda in the Eurozone this week. Well, the Bank of England Governor, Andrew Bailey, is striking, some would say, an aggressive tone on the rates market, saying to the Guardian newspaper this: if the news on inflation stays positive, the Bank of England could become a bit more activist in cutting rates, currently standing at 5%. Joining me now is Jill DeCease in terms of the rates market. I look at this rates market, there's comments as well from Ishiba. But if I look at sterling and yen, Jill, I've got a dovish pivot potentially from a gradualist Bailey, and I have restraint from a hawkish Ishiba in Japan. Good morning.
Good morning. Yeah, well, look, I think let's start with Bailey, right? This is a bit of a pivot, obviously, from this more of a steady as she goes, gradual approach from the BOE there. So I think it's really that language that you just cited there, a bit more activist, a bit more aggressive, that has markets, starting to price in not just, pretty much fully price in a cut in November, but also start to price in a chance of another cut in December. I mean, look, I think this is kind of reflective of the direction of the global economy right now. You're seeing a lot more resilience within the global economy. Inflation also coming down, quite a bit more. So that's giving central banks like the BOE more room to sort of, start, getting a bit bolder with, making these statements about cuts. We can talk more about Ishiba in Japan. I think that's really, the more jolty comment here, a bit more unexpected, coming in from this new prime minister, sort of speaking. It feels like, is it on behalf of the BOJ there, or what have you? But yeah, I think those are certainly more interesting comments because of how much that flipped, and has a lot of people that were expecting a rate hike in Japan by the end of the year now having second thoughts about that.
Yeah, it's interesting because I'm looking at various research houses and they're saying from Daiwa, for example, it's to try and soften the Ishiba shock. And he's basically saying the economy isn't ready for another rate increase. Do you think he's learning the reality of leadership and politics?
Yeah, I mean, look, he's kind of a self-described defense nerd. Remember, this is a guy that, when the LDP leadership elections were happening just last week, it was kind of a shock that he, was even put in this position in the first place. Now it seems like he's kind of learning how the markets are moving. We saw off the back of his election at the end of last week, the yen advanced, but you saw stocks fall in Japan. Maybe this is an attempt to kind of figure out how to reassure markets there. He's making these comments just after he came out out of a meeting with BOJ Governor Ueda. Is this a case where maybe the new, incoming prime minister has to, kind of figure out how exactly to work with markets or kind of massage some of that language to avoid these kinds of jolts in the future? Could just be maybe a very a valuable learning lesson for him as he comes in.
Well, we're certainly feeling our way into this new regime, from the Fed to the ECB to what happens with the BOJ and the BOE. Jill, thank you very much. Jill DeCease on the very latest rates narrative from the UK and Japan. Here in the US, traders are paring back their 50 basis point cut bets, and it's on the back of yesterday's ADP jobs data. The Apollo CEO, Mark Rowan, spoke exclusively to Bloomberg. This was before the data, I should say. But he did have a warning shot on aggressive rate cuts.
The notion that we would cut rates, financial markets are wide open, equities are at all-time high, financing is available, real estate prices are going up in every market, and yet we're stimulating, and we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time.
Kallum Pickering is my guest this morning, Chief Economist over at Peel Hunt. Mark Rowan there with Jonathan Farrow. Great interview. Rowan says this was a very expensive insurance policy cut. That's an interesting take from the rest of the crowd that are saying this was just holding things steady.
Well, look, I think if the Fed could be honest with markets, it would have probably gone 25 basis points a couple of months earlier and would have found itself in probably a better position. The question is now, now that the Fed has set such a low bar for 50 basis point cuts, what price will it have to pay in the future? I'm, of course, nervous heading into tomorrow's jobs report. If the unemployment rate ticks up, I wouldn't be surprised if markets shift back towards expecting 50 basis points. And then it's a question of how the Fed might react to that. I mean, I largely agree the US economy is strong. I don't think there's a justification for going 50 in the next meeting, but I do think there's a justification for taking funds rate towards neutral. Now, Fed members seem to think that that neutral rate is 2.9%. I think that's a little on the low side. I think we'd be less concerned about potential inflationary risks from aggressive Fed easing if the Fed just came out and said, actually, we think that the neutral rate's a little bit higher. So if we were aiming for, say, a 4% funds rate and the Fed were to get there over the next few meetings, I think markets would be relaxed. There'd be fewer two-sided risks around the next calls.
Look, you have consistently talked about this risk of reflation or a spike in inflation. And again, continuing on from that conversation at Apollo, the risk in 2025 is that we don't get to this 190, 200 basis points of cuts, which Larry Fink says is crazy.
Yeah, I think that's probably too much. I mean, even if the US economy has a cyclical mid-cycle slowdown over the next couple of quarters, which I think is likely, 100, 150 basis points of Fed cuts should be enough just to bring the momentum back into the second half of next year. I don't think we really fully appreciate, and central banks have not yet appreciated, just how much different the world is today versus pre-pandemic. I'm a Brit, so I'm allowed to say this, but I think we've had a Keynesian moment. The economy was sleepy before COVID. We gave everyone a rest. We had lockdowns. We juiced the economy up with fiscal and monetary policy. Since we've opened up, we've released an almighty amount of economic energy, and lots of things have normalized. We're much more aggressive in wage and price negotiations. We've reacted well to higher interest rates. And so I think central banks have to be cautious about not returning to that ultra easy mindset. If they go too far too fast, it's quite right that we should be nervous around inflation risk next year. And again, that's the price I think the Fed may end up paying for going a little too aggressive on the first move.
I was reading some of Marco Papik's research from GeoMacro, and he said what we do is we pivot from a cash-induced economy, which was all the COVID stimulus, to a leverage-induced economy in a rate-cutting cycle. And that has tail risk.
Look, I think we should just be clear here. There's a big difference between lowering interest rates and having easy monetary policy. Easy monetary policy is when the Fed gets the rate below neutral. So for me, the question is, where is neutral? I think it's higher than the Fed is signaling. For me, that's the key point. I think if we can get rates to, say, 4.5. I don't think we need to be too concerned. Of course, it depends a lot on what happens with fiscal policy after the election. But I think once we start getting below 4%, I think that's when you should start to worry a lot about credit cycles inflecting upwards, about potential inflation risks heading into the second half of next year. But in a way, we're back to a more business cycle environment. We're back to a degree, a bit of boom bust where central banks ease a little bit too much, they tighten a little bit too late. This is par for the course in a normal economy. It's just unfamiliar because we haven't been here for so long.
Well, one country which is delivering stimulus in familiar style and fashion is China. That combined with synchronized global rate cuts, what do you first of all make of the quality of the stimulus from China, and what does that do to the growth narrative?
Well, China has structural problems. Short-run stimulus will not solve structural problems. We roughly know what the playbook is for real estate corrections, for financial imbalances. We saw this in Japan in the 80s and the 90s. We saw this in Europe and the US in the mid-2000s. This takes a while to play out and to fully fix, but we definitely see a sense of urgency with the China policy response in response to the weakening growth momentum in the first half of the year. So what I think we're looking at here is near-term downside risks. The fact that they've reacted suggests that on the ground things are not good. But if you add up the Fed stimulus, the China stimulus, the fact that Europe is probably edging towards a quicker pace of rate cuts, altogether this means industrial production, global trade is probably likely to pick up into next year. And that's been the missing part of the upswing so far. Even in the US and the UK, where you've had strong momentum this year, it's almost entirely services driven. Europe has been weak because trade has been missing. Asia has been weak because trade is missing. And the global market is actually signaling that production and trade will be heading higher. If you look at the Dow on a year over year, for some 3 months, it's been leading trade and production higher. So I think next year, it's the upside risks that are more likely than the downside risks, judging by this synchronized stimulus.
I mean, we're counting down to Jobs Day tomorrow. We had the ADP numbers yesterday, which was adding jobs, perhaps with a little bit less heat in the wages component. Do you still think that the Fed is correct in their assessment of a fairly tempered, well-tempered level of unemployment, 4.2, 4.4 at a stretch?
Well, I certainly hope so. I don't see much of a risk that, at least judging by fundamentals, that US employment can tick a lot higher, and by a lot, I think we remain below 5%. The problem I have is, if you look at some of the signals in surveys, take the Conference Board signal, the difference between hard to get jobs and easy to get jobs, that's signaling a little bit of an uptick. And if I look at the consensus of economists for tomorrow, no one is expecting the unemployment rate to tick higher than 4.3%. So even if we got a 4.4, just an 0.2 percentage point move, that would come as a surprise. And so we're really in a market where the mixed signals on the economy are making it very difficult to predict month-by-month data. At the same time, you have the potential for global supply shocks coming from US port strikes, coming from the escalation in the Middle East. I think it's going to be difficult for the next few months to get a proper read. But again, my hunch is this synchronized cutting cycle is going to lead to a sizable recovery heading into next year across major parts of the world.
And that's where we pivot from soft landing to no landing, and that seems to be a building consensus. Kallum, thank you very much. Kallum Pickering of Peel Hunt. Other stories trending on your Bloomberg terminal this Thursday morning. This is what we've got for you. NVIDIA extends its jump higher. That's in the after-hours trading, as the chipmaker CEO Jensen Huang said in a CNBC interview that demand for the company's Blackwell chips is insane. The comments come amid concerns about engineering snags that delayed the release of the Blackwell chip. That Huang said yesterday that the chip was in full production. And it's another week where Warren Buffett has trimmed his holdings in Bank of America. Share sales this week fetched around $330 million. The pace of Berkshire Hathaway's offloading of the stock in the bank does seem to be slowing as its total holdings approach 10% regulatory threshold. Buffett hasn't said why he's paring the stake, but the firm remains the bank's top shareholder. LVMH and Formula One have signed a major 10-year sponsorship deal, potentially worth $1 billion. The French luxury group has usurped Rolex's spot as one of the race's top sponsors. LVMH is upping its presence in the sporting world after being a major sponsor of the Olympic and the Paralympic Games in Paris this summer. Coming up, Middle East tensions persist, oil rises, traders assess the supply risks. We discuss on Bloomberg. And a little bit later this hour, we speak to Aaron Kennon of Clear Harbor Asset Management on his outlook for the fourth quarter. Context matters on Bloomberg.
We are still very much at the bottom end of the range here in crude. This is not a market that's panicking too much about what will happen if there is a supply disruption, and that's because they are focusing on the OPEC plus spare capacity that's sitting on the sidelines.
That was Rebecca Babin of CIBC Private Wealth speaking to Bloomberg yesterday on the outlook for oil. We're bid again for the third day in a row. The world is bracing for what the retaliatory action from Israel against Iran will be. Supply uncertainty mounts as OPEC is making no changes to its plans to start gradually reviving production despite the impending surplus. There's a lot of conflicting views in this oil market. Paul Wallace is with me. Paul, I look at the oil market. It's bid, but it's not exactly on a major conflict footing. And this will come down to what Iran does potentially to the oil infrastructure within Iran. What would that do? It's the export facilities that we're perhaps most focused on.
Hi, Manus. Exactly. It is bid, but it's not up massively. I think we're up about 3.5% when it comes to Brent this week. But still below $75 a barrel and still below where it was in late August, early September. We are seeing a bit more action in the options market, and there do seem to be quite a few more buyers of $100 call options, for example. And call options are now becoming, they are now more expensive than puts again. But as you said, the market will probably react more once it knows what Israel's response is to this barrage of missiles that Iran fired at it on Tuesday evening. It is possible that Israel decides to strike Iranian oil infrastructure, and I think that would, possibly lead to the first energy supply disruptions from the region since October the 7th last year, when these various conflicts in the Middle East started. There's pretty much been nothing that's directly hit supply since then. But if Israel decides to go for Iranian oil infrastructure, be it refineries or export facilities, then yeah, I think that could really worry oil traders.
I mean, I look back when the Houthis hit Saudi infrastructure, and on that day, oil ratcheted by 20%. So we are nowhere near there. I think the risk for this market is, of course, as you say, the options market is bid. It's on the supply side, and OPEC is ready to put more supply back on the market. But the Journal article about $50 oil, it looks like OPEC are refuting that.
Yes, it does seem like they are refuting that, and the signs are that the group the OPEC Plus is going to continue with its plan to bring back some of that spare capacity that it has in December. So it doesn't look, according to a sort of meeting that some of its officials had yesterday, that they're going to pull back on that. So they are well aware that global demand is under a lot of strain at the moment, and there is quite a bit of supply growth from outside OPEC Plus at the moment, and 2025 looks like it's going to be an oversupplied oil market. But nonetheless, they seem like they're going to go ahead with their plan to boost supplies starting from December. But just to stress again, I think it is possible that things change once Israel makes known what it's going to do. And a lot of people think we'll find out in the next few days.
Indeed. Well, Biden has made it clear when he was asked yesterday in regards to supporting attacks on nuclear infrastructure in Iran. The answer to that was definitely a hard no. Paul, thank you very much. Paul Wallace tracking the oil story for us there. Coming up on the show, we'll look at what else are making headlines around the world for you. We'll take a look at the front pages.
Thanks, guys.
And the very latest on the destruction from Hurricane Helene. Context matters on Bloomberg. It's a Bloomberg Brief. I'm Anna Scranny in New York. Time for the front pages. These are the headlines from around the world. First up, we take you to the New York Times. The U.S. District Judge unseals new evidence in the federal election case against Trump. When the former president was told that his then Vice President Mike Pence was in peril as the January 6th rioting escalated, Trump replied, "So what?" Other accounts were revealed on Wednesday in a court filing, which the special counsel made his case for why Trump is not immune for prosecution on federal charges. Washington Post leads with Biden and Harris visiting the storm-ravaged areas from the air. 1,000 troops have now been deployed. The death toll has risen to 183 people. The destruction is expected to cost insurers around $6.4 billion. Here's what President Biden said approving the federal aid package yesterday.
Today, I approved the request of Governor Cooper for the federal government to cover 100% of all the costs for debris removal, emergency protective measures for 6 months, all the costs.
And on Bloomberg, we give you a little bit of private equity in sport. Miami Dolphins owner Ross Neers selling stakes to Aries and Psy. Properties include Hard Rock Stadium, Miami Grand Prix for Formula One, and the sale could value the team and other assets at around $8 billion. Or we go to Miami. I mean, the NFL are smart. No single fund can invest in more than 6 teams, and they can participate on the upside. Jobless claims are on the slate today. We'll push ahead with the agenda with Aaron Kennon from Clear Harbor Asset Management. From our global headquarters in New York, I'm Anna Scranny. Welcome to Bloomberg Brief. Let's set your agenda. Labour strength, Treasury slide as investors weigh the latest jobs data. Jobless claims and services PMI on deck today. Middle East on the edge. Oil climbs for a third day as Israel strikes Beirut. President Biden urges proportionality from Israel. And AI wins. NVIDIA's Jensen Huang says Blackwell chips are well on track. OpenAI raises funds to value the firm at $157 billion. Good morning. We are on the back foot this morning on equities. We're counting down to the jobless claims today. You had a little bit of a pop in yields yesterday on the back of the ADP numbers. Rubner over at Goldman Sachs warns, however, that his 6,000 target on the S&P 500 by the end of this year might be a little bit too low. So there's still some bullishness out there. NVIDIA is up 0.7% this morning. A little bit of a stronger action in the after hours yesterday. Demand for the Blackwell chips is insane. We'll talk more to our colleagues about that in just a moment. The bond market, look, the gains unraveled ever so slightly when we saw that hotter print on the ADP. Suddenly people do see a higher correlation between ADP and the non-farm payrolls. Yields up ever so slightly this morning, up at the short end of the curve, up by 1 basis point. What does it take from the non-farm payrolls to reignite a real 50 basis point cut risk? By the way, Trevor Greetham over at Royal London Asset Management warns of a bloodbath in these bond markets going into next year on fiscal issues and on the resurgence on inflation. Well, overnight in the Middle East, another Israeli strike on southern Lebanon, which the Israel Defense Forces claim have killed 15 Hezbollah fighters. This as the U.S. urges Israel not to attack Iran's nuclear facilities in retaliation for this week's missile barrage. President Biden says he plans to speak to the Prime Minister, Benjamin Netanyahu, as the G7 allies plan further sanctions on Iran. Here is what the president had to say on Israel's response to Iran.
Obviously, Iran has gone way is way off course. We'll be discussing with the Israelis what they're going to do, but all 7 of us agree that they have a right to respond, but they should respond in proportion.
Well, joining us now is our senior reporter in Dubai, Henry Meyer. Henry, the question is the calibrated response from Israel to Iran and also the timing and the targets. Yesterday, I had Anna Rosenberg with me from a Monday, and she was saying, look, this could be a moment where Israel goes after the nuclear facilities because they have got American backing. But that politically would be hard here. And you heard from President Biden himself. It's a hard no on that.
Well, that's exactly right. I mean, we know that Israel has been, itching to launch an operation to try and dismantle as much as possible Iran's nuclear program. But we see from the U.S. statements that the Biden administration is adamantly opposed to that. Having said that, Israel has ignored the advice of the U.S. So many times in the last year since this conflict started. However, it would require U.S. assistance for that raid to be done effectively. So, I mean, a lot of the reports are indicating that the most likely target would be Iran's oil infrastructure, refining and oil export facilities.
Does that then raise the specter of a response or via its proxies in that crunch point, the Strait of Hormuz? If they go after the oil export facilities, suddenly we're talking about a new escalation in oil infrastructure around the region, aren't we?
Well, of course, that's the great concern. I mean, we have, countries like Saudi Arabia and the United Arab Emirates, which are, at the moment, are really trying to do everything they can to dial back the tensions. But there's, very little influence they have. Really, no outside players at the moment are really able to put a stop to this. But clearly, it will depend on, the extent of the damage that's done in these strikes, which we expect to happen within the next few days, and on how Iran decides to respond.
It should be said that the Saudi foreign minister and the Iranian president, Pezeshkian, they met in Doha, so the discussions go on in Qatar in the background. Southern Lebanon, let's get to the images that we're showing at the moment. What is happening there? There's been more strikes from Israel into southern Lebanon.
Well, I mean, yesterday was a significant day where we had the first fatalities among the Israeli soldiers who went into southern Lebanon on Monday. 8 soldiers were killed yesterday. And, we can see that Israel is accelerating its operation, its military operation inside southern Lebanon. And, with more airstrikes as well in the center of Beirut. So we see an escalation there.
OK, Henry, thank you so much. Henry Mayer with the very latest on the Middle East. Clear Harbour's Aaron Kennon weighs in on the geopolitical risks with this. There are additional great powers that could enter the fray, and there are military mistakes that can occur, which could really create a tinderbox with a huge military, economic, and further humanitarian consequences. Aaron joins us now. Listening to Henry, Aaron, given the context of what you say, I just want to understand, what's the scale of retaliation that really shifts us from a sense of complacency in these markets to a material risk-off?
I think the markets, Manus, are right now of the view that this is a traditional Middle East skirmish, and it could very well be that way. What I mean by that is that markets could be temporarily volatile. But as you're seeing with the oil markets, we're not seeing any major spikes. And that suggests that there's quiescence on the capital markets front as it pertains to, sort of a fat tail risk that, you have a nuclear country in Israel that has significant capabilities, and you have an emerging nuclear power in Iran and an ideology at the top that has gutted their own country economically. And then, of course, you have 30% of global oil moving through the Straits of Hormuz, even though Iran's only about 4 or 5% of that capacity. And so there is a tinderbox opportunity, unfortunately, for this to go economically and from a humanitarian perspective, a little more pear-shaped. But Iran is sort of alone right now in the Middle East. You just mentioned Saudi Arabia. We don't hear much about Saudi Arabia as it pertains to what Israel's doing. And I think Iran is alone, too, because you don't see China involved in what's going on there. And Russia's obviously on their heels dealing with things up in Ukraine. But they funded the Houthis in Yemen, and that has disrupted our economic flow of shipments around the world. They've disrupted peace in the Gaza through Hamas. And now we were seeing in southern Lebanon, the only reason why Hezbollah is so consequential there is because Iran at the top has funded them. So they've done their people a real disservice. And I think economic opportunity could be brought to Iran if things were to change there, for sure.
And therein lies the point. They want to try and restart nuclear talks. If you look at it from the political prism here in the United States of America, Biden's faced with two pretty unpalatable options. One is supporting attacks on oil infrastructure and certainly supporting an attack on nuclear sites. Neither of these are politically what this administration wants to deal with right now.
Yeah, I think it's challenging right now for the Biden administration. I mean, I think clearly the United States citizenry sympathizes with the democracy that is Israel and them having the ability to defend themselves. And there's an election coming up, and you have key battleground states, particularly Michigan. We have a large Muslim population that sympathizes with some of the issues that are occurring in the Middle East right now. And so the Biden-Harris administration is clearly aware of that, and it's really a conundrum of sorts for them.
Are you making any tactical hedging moves on the risk? I mean, we look at a huge amount of option activity on $100 oil. A lot of action preparing for that outlier risk. Any tactical moves by you or any restraint by you in deploying risk at the moment?
I think it's maybe a bit of restraint from the perspective that if volatility were to rise further from here, and we've seen that really since the end of the third quarter, volatility in markets have risen across fixed income landscape, across the equity landscape, and they haven't, other than China, to a great extent, equities haven't been able to really move higher. And so when that happens and you have volatility, hedge fund managers, institutional managers tend to de-risk their positions. And so as long as there's, rising uncertainty, I think it's going to be difficult for markets to get out of the way here. And of course, you look at valuations in the equity market, and they look a little extended on a forward basis. But of course, that forward PE multiple is heavily represented at the top with Microsoft, NVIDIA, and the likes of those high growth sectors. If you look beneath the hood, there are other opportunities that we see across the landscape within the economy that are worth taking a look at.
Where are those biggest opportunities? I know you looked at the Russell, the small caps. Obviously, it's done very well in the third quarter, up 9%. I suppose the question is, does that rotation continue? Is that where the biggest opportunities are?
Well, I'm not sure if it's small versus large. I mean, certainly we're always looking at well-managed companies that are in areas of economic opportunity where the economic growth looks like it's sloping upward and can accelerate. It's all about rate of change. But, in the United States, one theme and around the world that we're seeing is the surging sort of electricity demand component. And that electrification that needs to happen due to the growth of data centers, the emergence and growth of large language models and artificial intelligence. And so there are lots of industrial companies in Europe, in the United States, that are very focused on that, whether it's battery storage technology, whether it's just sort of the more traditional industrial electrification processes. You saw a week or two ago Constellation Energy cutting a deal with Microsoft. We actually have the utility sector in the United States through the third quarter outperforming the technology sector. I don't think too many people know that because the utility sector represents such a small weighting in the overall index, but there are huge opportunities there. We're seeing private equity really become more democratized very quickly here in the United States. We're seeing this as an asset management firm, as a wealth management firm. There are opportunities in that landscape around private credit and private equity, not just to invest in those things, but invest in companies that offer those products. They're publicly traded. You had Apollo's CEO on yesterday. That's just one example of that. And of course, with uncertainty geopolitically, we have defense spending, both home and abroad. And I think that's going to become much more of a nationalized focus, too. You heard Emmanuel Macron yesterday talking about how Europe has to take care of Europe. And I think a lot of that also will mean that dollars or euros will accrue to defense companies based in Europe for the purposes of defending Europe, as one example, too.
Yeah, I mean, he is fairly visceral about the state of play in Europe. We didn't actually get to OpenAI raising $6.5 billion, giving them one of the best valuations, one of the biggest rounds that we've seen. Very quickly, what does that say to you about valuations right now? $6.5 billion, values OpenAI at $157 billion. It's one of the highest valuations we've seen.
Generative AI, they're the leader. ChatGPT, OpenAI, Mr. Altman is doing great things. It's about rate of change. The growth is unbelievable. The penetration rate over such a short period of time speaks volumes to the opportunity set. And so I haven't looked under the hood at the valuation per se, but at a macro level, it seems like there's a huge tailwind for AI. There'll be a lot of winners. There'll be many losers. And as investors, we'll have to try to sort that out in the weeks, months, and quarters ahead.
I think what's interesting with that, and we'll finish with this, is that the FT runs with the story, is that they've asked their investors not to invest elsewhere. That's what you call exclusivity. Aaron, thank you very much. Aaron Kennon, Clear Harbor Asset Management. My guest this morning on the markets. Good morning from New York. It's your Bloomberg Brief. I'm Menace Cranny in New York. NVIDIA stock is rising pre-market. Jensen Huang said the Blackwell production is underway and demand, get this, is insane. This was an interview yesterday. Joining me now is Tom McKenzie. Tom, good to see you. This is what the bulls want to hear. It caused trepidation at a conference a couple of weeks ago in terms of the unsteadiness of Blackwell. Good morning.
Yeah, look, they've had some production hitches along the way, but this was pretty clear coming through from Jensen Huang in this interview, has to be said with CNBC, saying, look, there is this insane demand for our GPUs. That the production of the Blackwell, which is their latest iteration of their AI accelerator, is moving at pace. And it absolutely, Manus, to your point, is key for investors. Is the demand still there? How far does it take us into 2025 and beyond? How elastic is that demand? Can they match? Can they supply and produce enough to be able to match that demand? Because so far that's been a challenge for NVIDIA. Is any of that capex spend from the hyperscalers cooling? I was speaking to Neuberger Bergman earlier on my show. They said they're seeing no signs of that whatsoever. They see signs of that demand continuing. That seems to chime and mirror what we've been hearing then from the CEO of NVIDIA.
And Tom, we've got to talk about OpenAI. They announced their new funding. It's the largest ever private investment, and the who's who, the royalty of investing, turned up. And Microsoft pitched in with a couple of dollars as well.
Yeah, they did. Look, building on that $13 billion that they've already built into OpenAI, of course. So they were in the mix. It was a who's who's. It was star lineup, of course. I mean, who wasn't in the mix is a bigger question. NVIDIA was there, Microsoft was there, and of course, Thrive Capital, who've been leading the charge in terms of some of the bigger ticket investments into OpenAI. And as you pointed out earlier, Manus, really interesting that they pushed for this exclusivity because it was so overly subscribed. They had leverage. The CEO, Sarah Fryer, the CFO of OpenAI, and the team there pushing for that exclusivity from an investor, saying, look, don't back the likes of Anthropic, don't back the likes of xAI. The rationale may be this: data sensitivity, IP protection, in terms of the eyeballs that the VCs will have on that kind of data and the concerns that it's going to feed back into some of their competitors. But it's also potentially going to ring alarm bells with regulators, whether it's in the US or in Brussels, who are concerned about what many may see as slightly anti-competitive, maybe monopolistic traits coming through from OpenAI. That could be an accusation that could be leveled at this business. There is a concern, certainly in Europe, about the role, the size and scope of some of these big players in terms of hoovering up that market share, and this may do little to assuage that concern. And you can expect as well, likely, a comment from Musk, who's already suing OpenAI and now is going to be hearing that xAI, his AI company, has been told from some of the VCs, don't invest there if you're investing in OpenAI.
Yeah, it's only going to be fisticuffs at Dom, verbal fisticuffs at Dom. We'll give you your allocation, but we want you to be involved. We don't want you to be involved in a meaningful way in the business. We want you to be involved in a meaningful way in the business, so you can't commit to our competitors. Tagline for the prospectus. Tom, thank you very much. Tom McKenzie on the very latest on OpenAI and NVIDIA. From San Francisco to Miami, the NFL's Miami Dolphins owner Stephen Ross is said to be in talks with Ares Management and the billionaire Joe Tsai to sell a stake with a valuation on the company of over $8 billion. That is according to our sources. Charlie Wells is tracking this story. It's a cracking story, isn't it, Charlie? I mean, what did he pay for this? Stephen Ross paid $550 million. That was 10 years ago. And it looks like this is a very rich deal.
Manis, I mean, these teams have appreciated significantly. I believe since 2020 to 2023, the average appreciation is about 70%. But as far as this deal, I mean, it would mark a pivotal moment in NFL history because it would be the first PE transaction, or at least a transaction involving private equity, since the league approved institutional investors to come in at a rule change meeting in August. Now, as far as what is potentially for sale here, what we know is this would include stakes in the Miami Dolphins. This would include the Hard Rock Stadium where they play, as well as F1's Miami Grand Prix. So a combination there, and that could potentially go to Ares Management, the private equity firm, and as you mentioned, Joe Tsai.
Indeed. The question is, how likely does this go through? As you say, it's a pivotal moment. When you look at what the NFL have done in terms of regulating this, no single firm of any of these people that they've approved, no single fund can invest in more than 6 teams. The NFL gets to participate in the upside. So they've got a real vested interest in helping this deal through, haven't they?
They certainly do. I mean, they want to set the marketplace. They want to make sure that the valuations for these teams following this rule change make sense and that they start to take shape. You know, these are long-term, difficult to value investments, and they want to start to kind of clear that marketplace. The NFL, as well as a lot of these family-based owners, want investment as well. You know, it's been increasingly difficult to, get state and local funding to pay for stadium upgrades. So bringing in some of that private equity money is, could be very positive. And something else that we need to talk about, and we started talking about this appreciation, is a lot of these family owners are getting older. They want some help offsetting the potential tax hits that they face.
And, in terms of this entire regime shift and this industry, this is just step one in terms of these deals, isn't it?
Manis, that's a really great point. This really is just step one. I mean, the NFL has long been, very closely held. These are kind of mom and pop businesses, if you think about it, with, family owners, local celebrities owning these teams, former players. They've had some of the strictest ownership rules in the world of professional sports. And so allowing in those institutional dollars, that could bring a lot of changes to the way that this league functions. We know mom and pop owners, local celebrities, they've got certain interests. When you bring in these private equity firms, when you bring in institutional money, the interests change significantly, and they are focused a lot more on the bottom line.
Okay, Charlie, thank you very much. Charlie Wells tracking the very latest NFL story there. Quick snapshot on what's going on in markets. There is a hesitancy in these markets. We're trying to understand the calibration, the significance of the response from Israel on Iran. But really, these equity markets are just that little bit hesitant. S&P 500 down by a third of 1%. You've got to consider, as we go to the jobless claims today, it's going to really have hesitancy between now and the non-farm payrolls tomorrow. Yields up ever so slightly, up 2 basis points. Coming up, we'll set you up for your trading day. We have got a little bit more economic data on this slate, along with You Got It, Fed Speak, right here on Bloomberg. It is Bloomberg Brief. I'm Menace Cranny in New York. Here's a look at what's on the slate today. Economic data around 8:30 a.m. Jobless claims, incredibly important post-ADP in advance of non-farm payrolls. Then you're going to get the S&P PMIs, 9:45. The services numbers come out at 10 a.m. So a lot of data to set you up for this bond market. Yields have spiked ever so slightly. Fed speak. Schmidt, Kashkari and Bostic all on the slate. They start speaking at 10 a.m. Some stocks to watch. Levi Strauss. Remember those jeans? They sink. They've tempered their full-year sales forecast. The third quarter sales also trailed Wall Street expectations. And a little bit of a check on commodities for you. This is what we've got. Brent is, that's Levi Strauss, I should say, pre-market down 11.59%. On the oil market, this is what we've got. We're up 1.7%. There's a lot of action in the options market at the $100 level. You're looking at quite a lot of call options trading there. Brent is bid. We wait to understand the Israeli response to Iran.